Assalamu alaikum wa rahmatullahi wa barakatuh, and good day to all of you. This is Faraniza Ahmad, and today we will be talking about managing solvency and liquidity. Before we dig into our discussion, let us first define the two terms involved in this topic: solvency and liquidity. Solvency refers to a company's ability to meet long-term debts and continue operating into the future. A solvent company is one whose current assets exceed its current liabilities. The same applies to an individual or an entity. Again, they are solvent when current assets exceed its current liabilities. If a company is solvent, it is able to pay its obligations when they come due and can continue in business. Thus, they are able to accomplish long-term expansion and growth as well as meeting its long-term financial obligations. Now, what about liquidity? Liquidity refers to both an enterprise's ability to pay short-term bills and debts, and a company's capability to sell assets quickly to raise cash. A highly liquid company generally has a lot of cash or cash equivalent assets on hand because they generally can't meet short-term operating needs by selling off pieces of equipment. Note that solvency and liquidity are both important for a company's financial health and an enterprise's ability to meet its obligation. Also, a company may have high liquidity but not solvency, or high solvency but low liquidity. A highly solvent company with a liquidity problem, for example, a cash problem, it can usually get hold of cash by borrowing it. Let's say it borrows cash from a bank, since banks are more inclined to lend customers who are solvent. Another case is that a company can be insolvent but has liquidity. This occurs if it has enough cash to meet its current or near-term debts. However, all of its assets are worth less than the total amount of money owed. Insolvency can be resolved if it has liquidity by reducing expenses to increase cash flow so that it eventually has more assets than debts, or by negotiating with creditors to reduce the total amount owed. Solvency can be measured by the solvency ratio. Expressed in a formula, solvency ratio is equal to total assets divided by total liabilities, and liquidity can be measured by the liquidity ratio. Expressed in a formula, liquidity ratio is equal to current assets divided by current liabilities. In this ratio, the larger the quotient or the larger the ratio is, the greater the solvency of a company or a bank. And the lower the ratio, the greater the chance the company is or may soon be suffering financial difficulty. But still, a high liquidity is not necessarily a good thing. There is a quotation by Dr. Ensai Bashkar Reddy: too much is bad, some is good, too little is poor. We can relate it with liquidity because too much liquidity limits bank earnings. Why? Because a high value resulting from the liquidity ratio may be an indication that the company is overly focused on liquidity, which can be detrimental to the effective use of capital and business expansion. And too little liquidity exposes a bank to the possibility of costly emergency measures to secure needed funds. So that is why a bank must strive to maintain adequate liquidity by managing it. Same applies to solvency. Solvency management is meeting a company's long-term debt. It involves coping with solvency risks. Solvency risk is part of financial risk like liquidity risk. In this risk, company is not capable to pay his debt. Solvency risk is more dangerous risk than liquidity because if you have not cash, you can borrow for paying debt, but if your liabilities are more than your assets, at that time, nobody will give you loan and your organization become insolvent. In managing liquidity, we need liquidity management strategy. Liquidity management strategy means that a business has a plan for meeting its short-term and immediate cash obligations without experiencing significant losses. It includes the ability of matching the liabilities with the assets, and its objective is to ensure that a company or a bank has sufficient funds to meet its contractual and regulatory financial obligations. Also, a liquidity management, we need to note that it is needed to cope up with the liquidity risks. The two types of liquidity risks are funding risks and asset liquidity risks. Funding risk refers to the risk that the company will not be able to meet its short-term financial obligations when due. It also depends on the perception of the market and credit standing of a bank. So a classic indicator of funding liquidity risk is the current ratio and the quick ratio. A current ratio, which is computed as current assets over current liabilities, and the quick ratio is computed by dividing quick assets by the current liabilities. In a bank, for example, there is a funding risk when it cannot meet the demand of customers wishing to withdraw their deposits. Asset liquidity risk, from the name itself, meaning it is an asset is not liquid or illiquidity of asset. So, an asset is not liquid when they are not readily tradable. And when an assets are not readily tradable, there is a risk of loss arising from an inability to convert assets into cash at carrying value when needed. It also arises when maturity of asset exceeds those of liabilities. So an asset of liquidity risk is sometimes known as market liquidity risk, since the process relates to the market price that is assigned to and can be obtained by a portfolio of assets. There are theories in managing liquidity, and this also applies to solvency. These are commercial loan theory, the shiftability theory, the anticipated income theory, and liability management theory. Commercial loan theory originated in England during the 18th century. This theory holds that a commercial bank must provide short-term liquidating loans to meet working capital requirement and should refrain from long-term loans. This theory is supported by real bills doctrine. It is a principle that money is lent against self-liquidating papers. However, the doctrine has some criticisms that made the commercial loan theory to be ignored. One of the criticisms of the doctrine is that it failed to take awareness or cognizance of the fact that the bank can ensure liquidity of its assets only when they are readily convertible into cash without any loss. Shiftability theory. Shiftability theory was originated in USA in 1918 by Mouton. It is an approach to keeping banks liquid by encouraging the shifting of assets. So when a bank has a shortage of ready money, then it can sell its assets to a bank that is more liquid. In this theory, most investments is made in secondary money market securities so that liquidity can be achieved at a little or very insignificant amount of loss of value. Also, a bank can also get cash from the central bank in case of difficulty simply by keeping the instruments as security. This theory presented an alternative way of real bill doctrine or theory where there is a possibility of risk because of economic depression in the case of buying and selling of commercial goods and raw materials. And just like the commercial loan theory, the shiftability theory was also ignored. Anticipated income theory was proposed and developed by Herbert V. Prochnow in 1948. on the basis of the practice of extending term loans by the U.S. commercial banks. So term loans, this is a loan for a period exceeding 1 year and extending to a period less than 5 years. This theory states that irrespective of the nature and feature of a borrower's business, the bank plans the liquidation of the term loan for the expected income of the borrower. The theory dominates the commercial loan theory and the shiftability theory as it satisfies the three major objectives: the liquidity, safety, and profitability. The said theory satisfies liquidity because the borrower saves and repays the loan regularly after a certain period of time in installments. And it fulfills the safety principle as the bank permits are relying on good security as well as the ability of the borrower to repay the loan. And lastly, the term loan is highly profitable for the business community which collects funds for medium terms. However, this theory also has disadvantage such as it anticipates that the income is not free from demerits, and it also fails to meet emergency cash requirements. Liability Management Theory. This theory is one of the important liquidity management theory that emerged in the year 1960. So this theory, the liability management theory, holds that banks can meet their liquidity requirements by bidding in the market for additional funds to meet demand and deposit withdrawal. And there is no need for a bank to follow all liquidity norms like maintaining liquid assets and liquid investments. For as long as they bid in the market, then they can be able to meet the loan demand and deposits withdrawal. According to the liabilities management view, an individual bank may acquire reserves from different sources by creating additional liabilities against itself. So these sources includes but not limited to: first, the issuance of time certificate of deposits, borrowing from other commercial banks, borrowings from the central bank, and raising capital funds by issuing shares and by means of retained earnings. Effective liquidity management requires three steps. First, identifying liquidity. Second, managing liquidity. And lastly, optimizing liquidity. These steps are interdependent, meaning each requires the successful implementation of the other two to optimally manage liquidity. Identifying liquidity. So this is the foundation on which the entire liquidity management process depends. It involves understanding the balances and positions of the institution on the enterprise-wide level. So after the identifying liquidity is managing liquidity, in which the identified liquidity is used to support the bank's revenue-generating activities. This may include consolidating funds, managing the release of funds to maximize their use, and then optimizing liquidity. This is an ongoing process with the focus on maximizing the value of the institution's fund. It requires strong and detailed understanding of banks' liquidity position across all currencies, accounts, business lines, and counterparties.